What is tail risk hedging? Have you ever wondered how investors prepare for those unexpected market drops that can shake up their portfolios? Tail risk hedging is a strategy designed specifically for that purpose. It protects against extreme market movements that happen rarely but can have a huge impact. These extreme events are known as tail events because they sit at the far ends of a probability distribution, usually more than 3 standard deviations from the average. Now let's talk about what tail risk really means. It's not just about losses, it can also involve unexpected gains. However, most investors focus on the potential for large losses. These losses are typically associated with the left tail of the distribution. Events like market crashes or sudden economic downturns can drastically affect stock prices, and that is where tail risk comes into play. To guard against tail risk, many investors turn to options trading strategies. One popular method is purchasing long-term put options. These options give you the right to sell a stock at a set price, which can be a lifesaver if the stock price plummets. Long-term put options are especially useful because they can be held for extended periods, allowing you to prepare for future downturns. When you are trading options, position sizing becomes essential in implementing tail risk hedging strategies. This means managing how much you invest in each trade to avoid overexposing your portfolio to potential losses. By incorporating tail risk hedging into your options trading, you can better manage risk and limit losses during extreme market conditions. However, it is important to note that tail risk hedging does come with costs. The premiums for long-term options can be quite high, especially when market volatility is elevated. This means you will need to weigh the benefits of protection against the ongoing costs of maintaining these hedges. Despite these expenses, tail risk hedging can be a key part of a risk management strategy, especially for those who are particularly sensitive to large losses. In summary, tail risk hedging is all about preparing for those unexpected market events that can have a significant impact on your investments. By using strategies like long-term put options and carefully managing your position sizes, you can protect your portfolio from severe downturns while being mindful of the associated costs.